friends, in today's session, we are going to discuss the derivatives. See, derivatives is a very important concept when you are talking about the financial risk management. Whether you're appearing for any competitive exams like RBI Grade B, whether you are appearing for the exams like JIB, CIB, and other exams like MBA exams, entrance exams, where the post is created for the finance officer. So this is a subject is very important, and this topic is very important, and the examiners always ask the questions from this topic because the financial risk management concept has now become such an important concept that you have to be understand the concept of derivatives because considering the geopolitical tensions prevailing across the globe and the financial assets are being exposed to the risk, so this topic becomes a very important. Let's understand what is a derivatives. So what are the derivatives? Derivatives are the financial contracts that derive their value from an underlying assets. Underlying assets may be a stocks or commodities. For example, considering US-Iran geopolitical tension or geopolitical risk. Now, due to this tension or war between the countries, the crude oil prices are being rising, or sometimes the crude oil price falls, gold price are rising, gold price are falls. So there is a volatility in a particular asset. How this volatility in a particular asset can be hedged or can be addressed in a proper way, it is through a derivatives. Derivatives means you are entering into the financial contract with another party through which you can hedge your risk. The risk is that unnecessarily increasing the crude oil prices, unnecessarily increasing the gold prices. Such risk can be hedged. Such you can provide get a shelter by entering to derivatives contract. So derivatives plays an important role in minimizing your risk and in hedging a risk. So that we will study in our subsequent slides what is derivatives. So there are typically two types of derivatives available. That is the future contracts. That is and option contracts. Where I'm talking about the derivatives, future and option contract, it means they have been properly regulated by the exchange. What are the future contracts and what are the option contracts, because they're having the certain standard terms and conditions which are being regulated by the exchange, that we will discuss in another chapter. So this is the picture gives you a broad idea what is derivatives. Those who have gone through this subject earlier also, they will be able to recall, but those who are been this subject is very new for them. Don't worry, we will study all these terms and terminologies in our subsequent slides. So first of all, आपको ये समझना है डेरिवेटिव्स का मेन ऑब्जेक्टिव ये है कि हमें रिस्क से बचना है। जो एक रिस्क है, जो प्राइस चेंजेस का रिस्क आ रहा है, जैसे लेट्स से क्रूड ऑयल की बात करते हैं। आज क्रूड ऑयल का रेट ये है पर बैरल और इतना शूट अप हो गया। तो जो इंक्रीज हुआ है प्राइसेस में, उनसे हम अपने आप को रिकवर कैसे कर सकते हैं या हम अपने उस रिस्क को कैसे हेज कर सकते हैं, उसके लिए हम डेरिवेटिव कॉन्ट्रैक्ट्स में एंटर करते हैं। आई होप इट इज क्लियर टू ऑल ऑफ यू। Study a derivative of contract or product whose value is derived from the value of some other known asset, which is the underlying asset. So this is the derivatives we have studied. Now, derivatives are based on wide range of underlying assets. This includes metals such as gold, silver, aluminum, copper, zinc, nickel, energy resources such as oil, agricultural commodities such as wheat, sugar, coffee, cotton, pulses, and financial assets such as shares, bonds, and foreign exchange. So means such type of assets are exposed to a different types of risk, and when you want to own these assets or when you want to having assets or how to protect the financial value of these assets, you enter into a derivative contract with the another party so that in order to hedge your risk. So let's study the derivative market history and evolution worldwide. The history of derivatives may map back to several centuries. Some of the specific milestones in the evolution of the derivative markets worldwide are given below. 12th century European trade fairs, sellers sign a contract promising future delivery of the items they sold. So, it's the evidence that the derivatives market beginning started in the year 12th century. Then in 1848, the Chicago Board of Trade facilitated a trading of forward contracts on various commodities. So in 1848, the Chicago Board of Trade facilitated trading of forwarded contracts on various commodities. Then in 1865, Chicago Board of Trade, went a step further and listed the first exchange traded derivative contract in the US. These contracts are called as future contracts. So there are two types of basically contract, future contracts and the forward contracts. Forward contracts are often called as over the counter products, and where the future contracts are called as the exchange traded contracts because they're having the standardized terms and conditions uh, you know on the exchange. So whenever the derivative contracts are traded on the exchange, they are with certain standard terms and conditions. They're called the future contracts. When they are any contract that has been entered between the parties, with informal terms and conditions, with not standardized terms and conditions, is generally called as forward contracts. So in 1999, Chicago Butter and Egg Board, a spin-off of Chicago Board of Trade, was reorganized to allow future trading. Later, its name was changed to Chicago Mercantile Exchange. Then in 1972, Chicago Mercantile Exchange introduced international monetary market, which allowed trading in currency futures. So this is how the derivatives industry revolve across the globe. In 1973, a Chicago Board Option Exchange became the first marketplace of trading listed options. In 1975, the Chicago Board of Trade introduced a Treasury bills future contract. It was the first successful pure interest rate futures. Then in 1977, Chicago Board of Trade introduced a T-bond future contracts. In 1982, the introduced Mercantile Exchange introduced Euro dollar future contract. In 1982, Kansas City Board of Trade launched the first stock index futures. In 1983, a Chicago Board Option of Exchange introduced option on stock indices with S&P 100 and with S&P 500 indexes. So this is the way how the derivative market has evolved across the globe. Now it is trading in India. Key milestones. So in November 18, 1996, SEBI creates a 24-member committee that is chaired by the LC Gupta to develop a regulatory framework. Then after in 1998, SEBI set up a risk containment group, uh, Professor J.R. Verma, to recommend measures on risk management. So basically, derivatives involves various type of risk, volatility risk, interest rate risk, currency risk, exchange risk. So default risk. How this risk has to be addressed while entering into the derivative contract. Then that in those days, the J.R. Verma committee has been formed to give a recommendation on risk management when related to derivative contracts. Then, the Security Contract Regulation Act was amended, and the term derivatives was included in the securities domain. Then the SICRA Act was amended to include the definition of derivatives as security was incorporated. Then in June 2000, SEBI permits equity derivative segment at NSE and BSE. Nifty and Sensex future commence. Nifty and Sensex index future commence trading. Uh, then in year 2001, Index options trading commenced. Then in 2001, options on individual stocks was allowed, and then 2001 May, after that, options on stock start trading. So this is the way how the derivatives contracts or the derivative journey has started in India. So it began in year 1996. So in it began in year 1996, first of all, trading in index, Nifty index and the Sensex index was allowed. Then after that, the option trading was allowed, and then the future contracts on individual stock allowed in year 2001. So this is how this journey, of the derivatives in India began. So derivatives mean now we study the types of derivative products. First of all, there is a future product. Future contracts, basically, the contracts, it means an agreement to buy or sell an asset at predetermined future date as well as a price. Suppose today the price of gold is, अगर मैं गोल्ड की बात करता हूँ, जो दैट इज प्राइस इज 10 ग्राम्स गोल्ड का जो प्राइस है, लेट्स से 1 लाख रुपीज है. नाउ आई एम होपिंग दैट ये जो प्राइस है वो राइज होके 1,20,000 हो जाएगा, 1,20,000 हो जाएगा इन आफ्टर 3 months. So now I entered into a future contract with the seller. I said कि I will buy gold after 3 months, but at a price of 1 lakh. So I have locked that price. I have locked that price for rupees 1 lakh. And the seller said okay. Seller said okay. So it means the seller is going to give me the delivery of the gold after 3 months to me at a price which is fixed today, that is for rupees 1 lakh. Irrespective of the fact that whatever the gold price remains there. The gold price may be at the time after 3 months, maybe rupees 1,30,000, or it may be a 1,10,000, irrelevant. But the seller is bound to deliver me a gold price, gold bound to deliver me a gold at a price of rupees 1 lakh per 10 gram. So this is called a future contracts. You know, the options are related to the futures, but in options you have the right but not an obligation. Let's say, I ask the seller that I want to enter into option contract that I will buy with not an obligation of gold at rupees 1,20,000. Suppose after 3 months the gold price is fallen to 90,000. It has not rose. The gold price has fallen. So in that case, I am not bound to buy the gold gold for rupees 1,20,000. In this case, I have not exercised my option. So option always said ki it is a right but not an obligation. But in future contracts, once you have determined, once you have agreed to buy a gold for rupees 1 lakh, you have to honor your commitment. You have to honor that financial commitment. This is called the this is called the future contract. But in option, it is you're not bound to honor the financial commitment. You have the right to buy, but not an obligation to buy or sell an asset at a set price. We will discuss next is swaps that we will discuss in our other another slides. That is agreement to exchange cash flows and liabilities. Forward contracts are different. They are different from the future contracts because future contracts are basically traded on exchange. They have a certain set of terms and conditions which are very standardized. But in case of the forward contracts, the terms and conditions are not standardized. It is a very customs. Uh, Standard terms and conditions are very custom, not standardized, and that's why the forward contracts are always called as over-the-counter products. They are with informal terms and conditions entered by the party. In case if one party makes a default, then the another party bears the loss of default risk, or bear the loss due to default made by the one party. But in future contracts, there's a concept of margin that we will discuss in another slides. That when you have entered into the contract based on the fluctuation of the prices during the future contract period, you have to keep a margin with the exchange, who is taking care of the future contracts. So there's a least possibility that the counterparty will make a uh, default on uh, date of maturity when the future contract is likely to be matured. But usually this is not in the case of the forward, because the forwards are, non-standardized contracts entered between the two parties. They are called as over the counter products. So when we are talking about the derivatives, who are the market participant, who are the parties that is involved in the derivatives? First of all, one is hedgers. Hedgers means persons who want to hedge their portfolio or their financial asset due to changes in their prices. That is, change in the prices. Suppose suppose I want to buy a gold. I want to buy a gold for a marriage purpose or from some other occasions, but I want that the gold I want to buy at an affordable prices, but the prices are fluctuating due to geopolitical tensions. So in that case, I will be entering to the derivative contract to hedge my gold stock to against the unnecessary increase in the prices movements, unnecessary increase in the prices. So hedgers. So this is why hedger plays an important role. Speculators means since there is a volatility in the market, the prices of in there's a volatility in the market, and the speculators try to grab an opportunities from such a volatility and would like to book a profit. So there is a fluctuations in the prices. There is a fluctuation in the gold price, silver price, other commodity price, and the speculator tried to, try to make use of such opportunity. Speculator tried to make an opportunity due to volatility in the prices, and they would like to gain a profit or sometime book a losses. Arbitragers, arbitragers, are the persons who try to find out the uh, price differences across the market, across the markets. So arbitragers try to find out the differences or in the different market. Suppose a particular asset is available, a gold is asset available in India for rupees 1 lakh per 10 gram, and the same gold is available in another country, you know, for rupees 1,20,000 per 10 gram. So arbitrator will buy a gold in India and then sell to another country for one rupees 1,20,000. So they have exploited the markets in which the price differences has existed, and they will try to book a profit on the basis of such differences or the discrepancies in the prices across the various markets. So brokers are the intermediaries that are facilitate trade between the two parties. The buyer of the derivative contract and the seller of the derivative contracts are not easily available. So brokers act as a intermediary who identify the need of the buyer who want to buy a derivative contract. At the same time, seller they also help in identifying the seller who wants to sell a derivative contracts. So broker provides a platform where the buyers and sellers of the derivative contracts interact, and accordingly the broker charge fees for their services rendered by them or called as platform fees, etc.